Hello, this is Peter Agripides, and I'm with Western Valuation Advisors. We have offices in Salt Lake City and Las Vegas, Nevada, and I'm going to be presenting today for the Quick Tip of the Week. The subject that we're going to cover today is built-in capital gains, and the way that I want to present this to everybody today is to go over a series of case law that actually begins in 1935 and goes up through almost our current date that everybody is watching this today. This area of case law is very interesting to me for two reasons. For one reason, it presents very linearly how this train of thought to adjust for built-in capital gains tax has evolved from 1935. And secondly, since it is such a linear progression of case law, it's something that really makes it easy for us to go and make the adjustment for built-in capital gains tax. One thing that I do want to talk about here at the beginning, and I will probably recap this at the end of the presentation also, is the fact that a lot of people refer to this as a discount for built-in capital gains tax. But here at the beginning, I want everybody to get into the frame of reference of looking at this as an adjustment for built-in capital gains tax. It's something that you can quantify numerically. You can look at a C corporation, you can look at the appreciation and the value of assets, and you can determine the exact amount of tax, built-in capital gains tax, that would be due on the date of your valuation. Okay, so we'll talk about that a little bit more as we get into talking about the actual adjustment. The first case that I want to cover here is the General Utilities Company versus Helvering. This became known as the General Utilities Doctrine. This held that a C corporation does not recognize income at the corporate level when appreciated property is sold or distributed to shareholders. This stood for about 51 years until Congress passed the Tax Reform Act of 1986, which made asset distributions taxable. The next case is Obermer versus the United States. This was in 1964. Up until the General Utilities case in 1935 through 1964 with the decision of Obermer, case law did not allow for a discount for built-in capital gains tax, or an adjustment, as I referred to it at the beginning of the presentation. They didn't allow for any type of adjustment because the imposition of the tax was too uncertain, remote, or speculative. This was the first case to allow for a discount for built-in capital gains tax. The discount was allowed because the asset sale was actually imminent. They were actually liquidating the company. 1997, we have Estate of Gray versus Commissioner. The taxpayer proved that a liquidation was imminent and a discount was allowed. At this point, the service agreed that the discount was applicable in theory, but they would only allow the discount or the adjustment in practice where the taxpayer could show that a liquidation was imminent. Estate of Davis versus Commissioner. This is in 1998. There was no planned liquidation, but the court used an economic reality theory to reason that a hypothetical buyer and seller would have agreed on a stock price after the corporation's built-in capital gain. But in the actual case, they did not apply a discount. So you can see the direction that we're moving now. We're moving from case law that says we're only going to allow any adjustment for built-in capital gains tax if a liquidation is imminent, to saying, okay, well, we can see in economic theory how a hypothetical willing buyer and hypothetical willing seller, when they sit down at the negotiating table, are going to take into account this tax because it's a real tax that they're going to have to pay. The next case is Eisenberg. This is also in 1998. The court said that the requirement of an imminent sale or liquidation was unnecessary. The court remanded the case back to the tax court for a determination of the discount. Then in 2000, we have Estate of Welch versus Commissioner. The tax court did not originally allow for a discount for built-in capital gains tax. the case was appealed to the U.S. Court of Appeals for the Sixth Circuit. The Sixth Circuit remanded the case back to the tax court and instructed the tax court to redetermine the fair market value, stop taking into account the actual built-in capital gains tax. Similarities between Eisenberg and Welch are both cases contain language that suggests the dollar-for-dollar discount might not be appropriate. This is important for some of the more recent cases, as we'll see in just a moment. The discount was based on the present value of the asset portfolio's turnover. One thing that's noteworthy to mention with both Eisenberg and Welch is you have C corporations that hold a large portfolio of marketable securities. So what the analyst did in this case was looked at the turnover, the historical turnover of the asset portfolios, and determined how long it would take to sell off the entire portfolio, and looked at what built-in capital gains tax or what capital gains tax liability would be assessed at each sale period, and they took the present value of that. Then in 2001, we have Jamieson versus Commissioner. Jamieson versus Commissioner says that the historic asset turnover assumes the incorrect standard of value. The court said that using a method which took into account the length of time over which the assets might be liquidated actually required the assumption that the buyer was a strategic buyer who would continue to operate the company. This is contrary to the notion of the hypothetical buyer. Okay. Next, we have Dunn versus Commissioner. This is in 2002. Dunn allowed a dollar-for-dollar discount for built-in capital gains tax. It took the position that even if the ownership interest was not large enough to force liquidation, the sale must be assumed to occur immediately. And that should make economic sense to us, or should make rational sense to us when we analyze the standard of value, fair market value. I mean, we're assuming in all of these cases that we're doing these within a tax setting, a report that's going to go to the IRS. When we're doing evaluation in a tax setting, we're assuming a sale, something that we commonly refer to in a litigation arena as value in exchange. And if we're looking at assuming a transaction takes place, it makes sense to us to say that the assets are being liquidated. Jelke versus Commissioner in 2007. This case allowed a dollar-for-dollar discount for built-in capital gains. Took the position that 100% of the assets were liquidated at the date of valuation. Okay, and this one was in the 11th Circuit. So we have the 5th and 11th Circuit now on board that you can take a dollar-for-dollar discount for built-in capital gains tax. Then in 2009, we have Litchfield versus Commissioner. The discount for built-in capital gains was allowed based on the historical turnover of the company's asset portfolio. So this is the only glitch in this series of case law. This is kind of reverted back to some of the older cases where they were using historical asset turnover as the determinant for how they determined the built-in capital gains tax liability. This case in 2010 was Jensen versus Commissioner. In this case, this involved a controlling interest in a C corporation. The decedent actually owned an 82% interest in the C corporation. The company in this case owned appreciated real estate. The court allowed a dollar-for-dollar discount for built-in capital gains tax liability. Something that's a little bit off the subject here, the court applied a 5% discount for lack of marketability to the controlling interest. This is not something that was litigated in court. It was stipulated by both parties, and they let the 5% deal go through. But what we have here, just kind of in recap, that's the last case that we're going to cover. But we have now the tax court with Jensen, the 5th Circuit with Dunn, and the 11th Circuit with Jelke that are now allowing dollar-for-dollar discounts or dollar-for-dollar adjustments for built-in capital gains tax liability. There's a little bit of contention, I think, within the valuation community as to, if I'm working in a state that is, let's say I'm working in Utah where a case may be appealed to the 10th Circuit, and the 10th Circuit does not have a ruling on this, should I still deduct 100% of the built-in capital gains tax? My position on that is that I still do adjust. I still do deduct 100% of the built-in capital gains tax, just as if I was working in, let's say, California, that would be appealable to the 9th Circuit, or another state that may be appealable to either the 5th or 11th that have already ruled on this. We have good case law. It seems to be the fact that the circuit courts that have heard this issue, that have had the chance to rule on this issue, are all doing the same thing. They are all allowing dollar-for-dollar discounts. Second off, we also have the tax court on board with Jensen versus Commissioner that is now allowing a discount. There was also a state case that was, I think, in Tennessee or something that also allowed a dollar-for-dollar discount. So I think we're in good shape now to actually